Moritz, I've been keeping a close eye on the price action the last 24 hours. We're seeing a major pullback across risky assets, from equities to rates, the dollar, you name it. And it really feels as though in the last 24 hours, investors' thinking has changed from rate cuts is good for risky assets to rate cuts could be a negative because it implies that growth is materially slowing down.
Yeah, good morning, Joumanna. I think that's hitting the nail on the head. We have been quite surprised about the resilience of the market for risk assets for a long time. I think the chicken are coming home to roost now. This is also the time of the year, obviously, where you often have a pullback from equities markets, for example. And indeed, the question about the rally that you just mentioned in treasuries is, I think the perspective is changing. I think people are no longer relying so much on this sort of teflon economy. And we are expecting a very weak reading, actually, on non-farm payrolls coming out on Friday, well below consensus. Don't get me wrong, we're not predicting the U.S. recession. I think this is a widowmaker call, really, but a slowdown. And we're moving out of the environment where equity investors say, well, rate hikes are good because it means the economy is strong, and rate cuts are good because it means that the financing conditions improve. So it's a much more balanced view. And I think this is healthy for the market to find a new, more balanced level, both for fixed income and for equity.
Yeah, it certainly feels like it. The other thing that emerged from the Fed meeting this week is the fact that, I mean, we've known this all along, but the Fed has a dual mandate. And for the most part of the last couple of years, they've been placing more emphasis on the inflation profile. For the first time this week, it felt as though Powell has started placing weight again on those labor market figures. So to what extent do you think now the attention of the market is going to switch away from the inflation figures to actually these upcoming labor figures, NFP today, JOLTS figures, and the like?
Yeah, this is really a very dovish statement, I thought, because you have this balanced view. As you say, in recent years, it was all about inflation, but the inflationary trends of recent months have really been going the way the Fed wanted. So you look at any indicator and you can see that inflation is coming down. We had the first month-on-month inflation reading in the negative territory for 4 years in June, but also core is coming down, shelter starts to come down. We're not out of the woods yet, but we're really on a good path. And it's natural that once you seem to have contained one problem, that you're moving to the other, and that is the economy, and the labor market is still solid, but it's visibly weakening.
Yeah, but it is, again, people are expecting the Fed to start with their rate cutting cycle in September, but then it becomes a question of how fast are they going to start cutting. I thought it was really interesting yesterday, our colleagues in the U.S. were speaking to the CEO of Barclays, and he said rates go up in an elevator, but they're going to go down by the stairs. They're going to go down gradually, possibly a cut every quarter. Are you in that camp as well?
Yes, I'm in that camp, absolutely, because what people sometimes refer to are previous cutting exercises or episodes, and they have been related to external shocks, like the financial crisis, like the pandemic, like 9/11. Now we're in a different environment. We're just basically in an environment where the Fed tries to contain inflation and getting back to target, and this calls for a much more gradual approach. So I think the market got a little bit ahead of itself. I think they're predicting close to 3 cuts. I think there will be 1 in September. That's a long-held view. And then 1 right after the election. But the election outcome is very, very important. And a Trump win would be quite hawkish. And I would think that this might actually halt the cutting cycle if he comes out victorious, because his economic program is highly inflationary, and the Fed will have to react to that. But till the end of the year, 2 more cuts, I think, are in the bag. For 3 cuts, I'm really lacking the imagination to see the scenario where this would happen.
Yeah. Let me just ask you about the Bank of England and the commentary that came out yesterday, because they finally did cut. It was split. It was very finely split, 5-4. But again, in the press conference and throughout the interviews that our colleagues, Francine, sat down with the Bank of England governor, he seemed to suggest that, again, they're not in a hurry to commit to further interest rate cuts either. So what do you make of the remarks and what we got out of the Bank of England yesterday?
Well, I think the Bank of England used the window of opportunity to cut. I mean, the rates were very high, the 5% plus. We expect, just like the Bank of England itself, that inflation is actually picking up slightly. I would think by the end of the year we might see 3% again. That's simply because the base effects, the positive base effects from energy prices are dropping out. And now we are sort of falling back on the domestic drivers of price increases. And it would have been much harder to communicate a rate cut sort of 3 months down the road when inflation is going up again. Now we hit the target 2%.
Yeah.
It's not sustainable. It will go up again, but I think they used the window of opportunity. And even so, you could see it was very, very narrow, this vote. So I don't expect very much action going forward.